Hi there, I'm David from DEB Chartered Accountants. This video is part of a series providing information to business owners to help them reduce their tax liabilities. The subject of this particular video is consideration of how salaries form a key part of the profit extraction strategies that is available to director shareholders of a small limited company. For a director shareholder of a small limited company, the number one strategy for getting profits out of their company should be the payment of a minimum salary. This can then be topped up to the income level that they require by means of dividend payments. We will consider dividend payments in a later video. The question is, what is the best salary to take as the first tier of your profit extraction strategy? This varies depending upon personal circumstances of the director shareholders. However, to work out the optimum salary to take, you need to be aware of a number of tax and national insurance thresholds. The first thing you need to be aware of is the annual personal allowance for tax. This is the amount of income that anyone can have before they start to pay tax. Assuming that this allowance is not used up elsewhere, any salary which is taken below the personal allowance will not be subject to any tax. Some of this income, however, would be subject to national insurance contributions. So we also need to take into consideration the thresholds that apply to national insurance. With national insurance, there are three thresholds to consider. The first threshold is called the lower earnings limit. If your salary exceeds this level, then you will receive a full credit for state benefits, the most significant of which is the credit towards your state pension. At this level of salary, it costs you nothing in contributions. So salaries that reach this lower earnings limit and are reported to HMRC under the real-time income system are tax-free and get you the national insurance credit whilst costing you nothing. Furthermore, the cost of the wages is tax deductible for your company and so will reduce the amount of corporation tax that the company pays. The level of salary that provides this win-win-win situation can be increased all the way up to the next national insurance threshold, which is called the primary threshold, and still achieve the wins for the director shareholder and the company. Once the primary threshold is exceeded, then any additional salary over the threshold will incur employees' national insurance contributions at the prevailing rate. So if you pay above the primary threshold, then this will still not be subject to tax, as it would still be below your personal allowance. It would, however, be subject to employees' national insurance contributions, but as the rate of the employees' national insurance contributions is lower than the corporation tax rate, then you would gain by the difference between these two rates, so long as your company makes enough profits after paying your salary on which to pay corporation tax. If this was the case, you could consider increasing your salary up to the next threshold. If you don't pay corporation tax, or you're not prepared to accept the cash flow consequences of having to pay employees' national insurance contributions now and throughout the year, in order to get the later corporation tax saving 9 months after your accounting year end, then your optimum salary would be just below the primary threshold. At that level, you maximize the amount you can take without paying any tax or national insurance, whilst establishing your national insurance credit. If you do pay corporation tax, then it could be in your interest to pay larger salaries up to the secondary threshold. This is the salary level beyond which you will pay an employer's national insurance. As the income above this level will attract both employees and employers' national insurance contributions, then the total national insurance cost would exceed the corporation tax relief that you would obtain on the excess over the threshold. Thus, you would not want to exceed the threshold to avoid paying both types of national insurance contributions. It would seem logical, therefore, that the secondary threshold would be the level up to which salaries were paid. However, it's not quite as simple as that. For one reason or another, one or both of these contributions might not be payable. For example, an employee aged over the pensionable age would not pay employees' contributions. Also, if the employer's contribution in total falls below the employer's allowance, then these contributions would not be payable either. Where only one type of national insurance contribution is payable, either the employee's contribution or the employer's contribution, and where the company is paying corporation tax after paying the salary, then it pays you to push the salary all the way up to the level of the personal allowance. So, depending upon whether the company pays corporation tax or not, and whether one or two classes of national insurance contributions are payable, the ideal salary levels could vary from just below the primary threshold, or just below the secondary threshold, or indeed to the full level of the director's shareholder's personal allowance. As there are timing differences between the payment of national insurance contributions, which are payable either monthly or quarterly during the year, and the corporation tax, which is 9 months after the accounting period, then the ideal level of salary may also be affected by cash flow considerations, and thus personal preferences could come into play. Salaries play a key part in a director's tax strategy. As you will have gathered from this video, there are a number of factors to be considered. This is where your relationship with your accountant comes into play in discussing this. Discussing salary levels with clients plays a key part of the strategies that we at DEB tailor to their particular needs. The tax and national insurance rates and thresholds often vary annually, whilst personal views and circumstances can vary from day to day. Thus, the optimum salary you pay yourself needs to be subject to regular review. Throughout this video, I've deliberately avoided giving specific amounts for the thresholds and the tax and national insurance rates. This is done deliberately to avoid this video becoming obsolete as these numbers change. A simple Google search will provide you with the numbers relevant to the current tax year. So-called minimum salaries provide a very significant opportunity to help save tax. These should be utilised alongside dividends to determine a strategy that will vary from individual to individual. I hope that this video has been of help to you. Bye for now.